3. A structural shift, not a temporary blip. This isn't just a market hiccup. The surge in yields is tied to a policy shift, government stimulus, rising debt issuance, waning central bank support for bond market intervention, and changing investor sentiment. Multiple bond maturities, 20Y, 30Y, 40Y are all spiking together. That shows yield curve steepening, not just short-term volatility. Domestic Japanese investors, insurers, pension funds, banks who once supported bond demand are stepping back due to mark-to-market losses and rising risk. That means the safety net for the bond market is weakening. One more shock could trigger a cascade of selling. In short, this is a paradigm shift, not a blip. Everything financial markets built around the assumption of ultra-cheap Japanese debt is under threat. 4. What history says and why this rings alarms globally. We've seen carry trade unwinds before. Volatility spreads fast. As risk appetite evaporates, investors retreat from equities, high-growth stocks, even safe bonds. Long-duration assets like growth stocks, tech, REITs are especially vulnerable when yields rise. Credit markets tighten. Companies with heavy debt loads struggle. Refinancing becomes more expensive. Liquidity dries up, forced selling, margin calls, risk-off cycles. Put simply, what starts as a bond market crisis can quickly morph into a full-blown financial crash if conditions aren't contained. Given the scale of debt, global bond holdings, and interconnectedness, many analysts today call Japan's situation a potential trigger for a global reset. 5. What you should do right now if you care about protecting your money. Here are steps to consider, not financial advice but prudent precautions. To review your exposure to interest rate risk. If you hold bonds, long-term debt instruments, or growth stocks, know what could happen if yields spike. Diversify beyond dollar-heavy assets. Consider assets that historically perform during rate or yield crises. Commodities, precious metals, inflation-hedged assets. Favor companies with strong balance sheets and real cash flow. These are likelier to survive rate volatility. Pay down high-interest or variable rate debt, adjustable mortgages, credit cards, variable loans because borrowing costs might rise. Watch key indicators tightly. Japanese bond yields 10Y, 20Y, 30Y, 40Y currency moves, especially yen versus dollar. US Treasury yields and credit spreads. Demand at major bond auctions in Japan or US. Have a contingency plan. Decide ahead of time what you'll do if a major bond sell-off triggers a market crash. Sell, hedge, hold, or shift assets. Being prepared doesn't mean panic, it means staying ahead of the wave. 6. Closing. What this could mean for you. We may be witnessing a historic shift in global finance. The cheap money era, supported by ultra-low Japanese yields and massive carry trades, may be ending. That changes the rules for everything. Mortgages, stocks, retirement accounts, borrowing, even governments. But awareness is power. If you know what's happening, you have a chance to protect yourself. At Finance Flix Hub, our goal is to bring you these warning signs before they hit headlines. Stay alert, stay thoughtful, and above all, stay in control of your financial future. Thanks for watching. Please subscribe. Thanks for tuning into Finance Flix Hub. If you found value in this breakdown, hit that subscribe button, like this video, and turn on notifications so you don't miss future updates. We're tracking these developments closely, and we'll be back with more deep dives, analysis, and actionable insights. Stay sharp, stay safe. Hey everyone, welcome to Finance Flix Hub. If you've got a 401k, a mortgage, or any money in the stock market, you need to hear this, because something big is breaking right now, and most people don't even realize it yet. Japan, yes, that's right. Japan is sending shockwaves through global markets, and those shockwaves could hit your wallet, your retirement savings, and every corner of the US economy. By the end of this video, you'll understand what's happening in Japan, why global markets, including US stocks, treasuries, even your mortgage now face serious risk, what you can do today to protect yourself. Let's dive in. 1. The trigger. Japan's bond market is breaking. What's going on in Japan right now in 2025? Japan's long-term government bond yields to 20-year, 30-year, and even 40-year have surged to historic highs. For example, 30-year yields passed 3% levels not seen in decades. Even the 10-year yield, long political and market sweet spot, recently rose sharply. Why? The government under new leadership approved a huge stimulus package, the biggest in years, to try to prop up growth. Fiscal spending went up, meaning debt issuance rose, but investor confidence dropped. Demand for long-term bonds weakened. Auctions of 20-year and 40-year bonds saw weak demand. On top of that, the central bank is tapering its bond buying program, part of its loose money policy, which means more supply meets weaker demand, a recipe for higher yields. Bottom line, the era of ultra-cheap Japanese bonds seems to be ending. What once was considered safe debt is becoming risky. To how Japan's mess becomes a global problem and a US problem. What's the connection to the US and global markets? For years, Japan has been one of the largest foreign holders of US treasuries. Their demand helped keep US borrowing costs lower. Many Japanese investors borrowed cheap yen thanks to near-zero interest rates and invested in higher-yielding US treasuries. That's the famous carry trade. But with Japanese yields rising, the math flips. Domestic bonds become more attractive, so Japanese investors may repatriate, sell as treasuries, and return capital home. That could flood the market with supply of US bonds while demand falls, pushing US yields up, bond prices down. Because yields and bond prices move opposite, why this matters to you. Rising US yields mean higher borrowing costs. Mortgages, car loans, credit cards, business loans all get pricier. Higher interest rates also weigh heavily on stocks, especially growth and tech stocks, because future profits get discounted more heavily. If institutional investors start liquidating large portfolios, stocks, real estate, even crypto, we could see broad market drops. So even if you don't own Japanese assets, you re-exposed via global interconnected markets.